Good morning. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris and I'm the Marketing Manager at Genghis Capital. Today is the penultimate edition. That means it's the second last briefing we're having for 2020. So we're glad to have you, and we're glad to have so many of you to be returning attendees of our webinar. As per tradition, we're going to be covering different segments of the financial markets. We'll have Gerald covering equities. So he'll be sharing with us the developments in the stock exchange, as well as giving us recommendations for the week. Then we're going to have Churchill, who's going to talk to us about the macroeconomic developments in Kenya. I'm sure a large number of you must have received his latest notes, DSSI. So Churchill, maybe you'll drop a couple of that highlights from that. He'll also share with us developments in fixed income. Then we have Mathew Kabeere joining us once again from FXPesa. Mathew is going to be talking to us about the global financial markets, something that a great number of you really enjoy. So thanks, Mathew, for coming in. The session is interactive. Please feel free to use the Q&A section to share your questions. I really want to urge you to use the Q&A because it makes it easier for us to be able to pick it up. But you can also use the chat to share any comments and concerns you have. So let's get started. Gerald, over to you.
Thank you, Damaris, and good morning all. Let me share my screen. So we'll start by a recap of market performance last week. We saw some bearishness over the course of last week, but very slight. I think when you look at the NASI and the C20, are down very slight, about 0.1 and 0.2 respectively. I think this, coming from the prior week, you could say that the markets, there's still that uncertainty despite some positive news, and then we have some negative news, because in the prior week, almost all markets in SSC that we usually look at on a comparative basis, they were on a positive side. But the last week, we saw some profit taking. Most markets were in the negative. So markets are still uncertain about the direction of the pandemic, despite having positive news about basically the vaccines that are fairly effective. But then we have rising cases. So that's still going to happen for the most part of this month, and also for major part of December. But however, if there's a very clear way forward in terms of how the vaccine is going to be, then I think markets could start to stabilize a little bit. So turnover was fairly flat, about 5.2%. So this is definitely below the ideal week averages, which usually is about over 3 billion shillings on a weekly average. So fairly low activity levels in the market. Top gainers. So you notice the top gainers last week, Bamburi. We usually don't see the large cap stocks as part of the top gainers or top losers on a weekly basis, but Bamburi was the key standout across last week. And then you also had BOC and EA Cables. Then the top losers were Express, TCL, and Kapchorwa T. Remember, there was some news about Kapchorwa T some weeks ago. Foreign activity participation rose from about 53% in the prior week to about 78%, quite high. And then there was a net inflows, and then this was basically spread across 3 stocks. So fairly balanced in terms of flows, but it was quite small, about 19 million in net inflows. So accumulation still on Safaricom. For many weeks now, Safaricom has been a key stock that foreigners have been accumulating. ABL again for the second week. I think there's some bullishness and then some price action in terms of EABL at the price levels that we are seeing, and you'll see that in our recommendations. I think when you look at EABL recently, it's been trading at below 160, and this is a very attractive price point that foreign investors are looking at. So exit, Equity and BAT Kenya, basically they have been exiting for most of these, including KCB last week. So top traded was Safaricom, BAT Kenya, Equity, and the usual EABL. Now, in terms of where we are trading at versus our SSA peers, so market P, we are at about 10.1 over the average of about 8.7, but dividend yield is almost similar to the SSA average. And when you look at the market performance week on week, there was a bit of profit taking. You can see on average, the African markets were negative across the most part of last week. So for trading ideas, as I mentioned earlier, this week we are keen on EABL. We've seen over recent week, especially last week, prices dipped to 150 levels, and there was a lot of investors looking to enter into that stock at those price levels. So we still expect that, as the price sustains below the 160 levels, there's going to be a lot of investors coming in. So also on a fundamental outlook, I think previously we had expected that bars and other social events would be back from January, but so that we reopened much earlier than that. So it means that a lot of volumes in terms of the products of EABL will benefit from the festive season as we start off in basically in December. So however, there's still risks, as we all know about the wave 2, and we have seen some numbers quite high. So it is key to check out what to be on the lookout on what the government may reintroduce as restrictions. But I don't expect to be much severe restrictions as it was. But remember that bars, for one, are some of the areas that have been highlighted as social area that is in terms of spread of the pandemic is one of the processes that attracts a lot of transmission. So we have maintained the take profit stance on Standard Group. It has barely moved since now we recommended investors last week to cash in on the 35% gain over the quarter. I think now we are almost 2 months into the quarter, and we think that a 35% gain on basically 6 weeks, 7 weeks will be quite good a return for investors. Corporate calendar. So still announcements from the banking sector. There are a couple of banks still yet to announce, but the key banks have already announced. Still awaiting results from Diamond Trust Bank and I&M. And you expect performance to basically be what we have seen from across the other banks that have announced, basically substantial increase in provisions, and then negative growth in basically the bottom line. And then the income lines have been fairly solid for most of the banks, but an interest income line has taken a hit due to the various measures that have been introduced by the Central Bank of Kenya and government basically, that has impacted transactional activity across most of this year so far. So maybe Churchill could take over with macro and fixed income, and thank you for your time.
Thanks, Gerald. Let me take you through my screen. Yeah, morning once again. So I'll take you through the macroeconomic bits, and then I'll finish on the fixed income segment. I'll start off with the October 2020 statement. This was in Friday's Kenya Gazette issue. Just highlight of the revenues and net expenditure data as at that review month. So in terms of ordinary revenue, our total was 458.3 billion, whereby tax receipts was for 26.4, and the non-tax was 31.9 billion. In actual data, the tax receipts in the month of October was around 108.7 billion. But on a year-on-year comparison, that was a decline of 13.7%. And on a month-on-month comparison, that was 16.1% decline. But that said, the significant impact of the year-on-year dip has been the effect of the tax relief measures, which were contained in the Tax Laws Amendment Act 2020, which revised downwards even the revenue numbers to the tune of 222.9 billion in the current financial year. So that dip is not apple-to-apple comparison. Rather, it's been significantly impacted by that downward revision on the taxes. If you go to gross domestic borrowing, the total was 264.8 billion. In terms of expenditure, recurrent was to 95.8 billion. This is between July up until October. But for the month of October, the recurrent expenditure was 72.9 billion. Development expenditure for the month of October was 12 billion, of which cumulative between July to October was 92 billion thereabouts. Counties disbursement, what happened in the month of October, there was arrears for the months of July and August to the tune of 52.2 billion that were paid out in that review month. So that meant that the county's disbursement over and above the 26.2 billion that had been paid out, total 78.4 billion. If you look at the public debt servicing, that's payment of interest and also the redemptions, it totaled 246.3 billion. Sorry, that's my presentation is squeezed out the numbers, but that represented 53.7% of ordinary revenue. So in simple terms is that for every 100 shillings that was collected in ordinary revenue, which was for 58.3 billion between July and October, 54 shillings of that went to settling of the debt, be it payment of interest and payment of redemptions, and that is quite concerning. 46 shillings out of every 100 is now left for recurrent, development, and also county disbursement. That's quite concerning. On Friday, we put out a note, the debt service suspension initiative. This came out from media reports that Kenya was considering that the SSI, in short. The news article came out on Thursday, so we did out a note just putting our thoughts around it. And basically, this DSSI is a debt suspension and not debt forgiveness. So what do I mean? I've mentioned in the previous slide that 246 billion was paid out between July and October. So essentially, had Kenya gotten into this DSSI, we would not have paid that significant amount, or for every 100 shillings, 54 shillings will not have gone to paying debt servicing. So it could have been a relief. But that said, it's not a forgiveness, meaning that at some point we'll have to pay it back. But of course, this DSSI came just to tackle the COVID-19, whereby some of the poorest countries, Kenya being one of them, considered under the World Bank criteria. It was also eligible to tap into this DSSI. So what happened from the media reports, because initially around May, July, June, thereabout, Treasury had come out saying that it will not get into the SSI, but then it seemed like there was a U-turn on that initiative. So we are seeing that the DSSI is being provided by G20. That's the group of 20 most developed countries, and also supported by the Paris Club, which comprises of 22 countries. There's an overlap of some countries who belong in both the G20 countries and also the Paris Club countries. But the Paris Club countries are now the official bilateral creditors. If you look at some of the G20 countries, we are seeing countries such as Argentina, we're seeing countries such as Mexico, we're seeing countries such as South Africa, which also at the moment they've been having some concerns, fiscal concerns. Last week, South Africa was downgraded by Moody's. We know that Argentina defaulted on its debt sometime early this year. So those are also some of the countries under G20. So ideally, in our analysis, we're looking at the Paris Club as one of the main significant player in the event that Kenya seeks the SSI, and coupled with some of the other countries in the G20, which includes China. Of course, the debt suspension was slated for the 1st of May this year up until 31st of December, but it was further extended for 6 months up until 30th June next year. So what happens is that in the event that Kenya seeks debt suspension for that period, it will be able even to get a refund of some of those debts that it has already paid in the previous months before it tapped into the DSSI. So that is something that has come out, and also it can be able to request for suspension for a further 6 months, but that means that it has to get into the initial debt suspension period first. Hence, it's quite critical. We just have 1 month before the lapse of the initial debt suspension period, which is being December, before now it can seek even an extension for further 6 months. I mentioned earlier that China is one of the G20 countries, but China government-to-government loans is quite paltry. So the main Chinese lenders are now state-owned corporations, China Exim Bank being one of them. And we know that it funded the SGR Phase 1 project that was 329 billion shillings thereabouts. So it's been one of the main significant players. So in the event that now China, via China Exim Bank, gets into this debt service suspension initiative, we're likely to see some significant savings for the government. But of course, these savings, quote unquote, because ultimately we'll have to pay them, will have to be geared towards some of the critical sectors to fight COVID-19. But that said, later that Friday, we saw a press released by the CS of Treasury, that's Ambassador Ukur Yatani, denying that Kenya was actually seeking that DSSI. So we'll still be on the lookout on developments from this front. Moving on, IMF were in town. They concluded a 3-week discussions looking at facility budget support, a 3.5-year IMF budget support facility. This facility is to provide resources for some of the vulnerable groups, also to reduce debt vulnerabilities. For the current financial year, we're looking at debt accumulation to the tune of 1 trillion shillings. So, and on the domestic front, we are seeing 600 billion of that majorly coming from banks, and that already is a shock to the market. So with the budget support facility from IMF, at least it's trying to reduce that kind of the vulnerabilities, even to the banking sector. And also, of course, there's an aim with that there should be some fiscal consolidation whereby revenue numbers needs to edge up at least once Kenya will be in this facility. That facility is yet to be hammered out. There are a few technical nitty-gritties that needs to be ironed out, but should be out by early next year. In terms of the calendar for the week, we are seeing public sector hearings, the budget that will be presented by the CS next June. So right now is when public sector hearings for that will be kicking up in earnest mid this week from Wednesday up until Friday. There's also the World Bank Kenya Economic Outlook report that will be out Wednesday afternoon thereabout. And on Thursday, we have the CBK MPC meeting just to review the CBR rate, which is at 7%. Most likely, it will have a neutral monetary policy stance, meaning that it will not change the CBR at 7% in our view. Moving on to the fixed income, the review for last week, we saw the secondary markets bond activity jumping up close to 32%. That was 12.6 billion, of which most of the trades that were traded were on the short end of the yield curve, 5 years and below. On the T-bill segment, we saw it at 25 billion, down from the previous 30 billion bids that came in the weekly auction. That 25 billion represented 104.2% performance rate. Just looking at how yields have moved since mid-July levels, you've seen that yields have gone up 0.71%. And in the quarter, that is October up until right now, it's gone up close to 0.4%. Moving on to some of the other segments on the fixed income side, liquidity trends, we are seeing the interbank rate, average interbank rate for the week was steady at 3.01%. In terms of the open market operations, whereby CBK either comes to mop up excess liquidity or injects liquidity in the market, last week, it was mainly on mop-up activities, whereby it sought a cumulative 85 billion. In term auction deposits, it received 47.2 billion and accepted 47 billion of that amount. Just estimates on the net domestic borrowing, right now we are 284.4 billion. That is inclusive of the CBK overdraft facility, and that represents around 47.4% of the revised target. That is 600 billion that I mentioned earlier on. Just looking at the results for November primary bond auction, the total amount that was sought by the government was 40 billion. Bids received 56 billion, total bids accepted was around 54 billion, of which the weighted rate of the accepted bids in the first paper, that's FXD2, 2013-15 was 11.445%. So we know the rule of thumb, if the yield is lower than the coupon rate, you find that the dirty price, the price for that bond for every 100 shillings is above 100. So that came to 103.85. And for the second bond, the FXD1 2018-20, whereby the weighted rate of accepted bids was 13.247%, we saw that the dirty price was around 1.92. Obviously, still the rule of thumb applies, whereby the yield, if it's above the coupon rate, you find that the clean price is below 100. For every 100, you find that the figure is below 100. So, of course, the dirty price adjusts the accrued interest portion, basically what amount of coupon that has been earned since the last coupon payment. So that now gives us 1.92. Moving on to the week's trade, which is basically from last week's auction. In particularly, we're looking at the FXD2 2013-15, which is basically 7.5 years to maturity. The pre-auction levels was around 11.02%, which had a dirty price of 105.69, and right now the dirty price based on the auction numbers is around 103.85. So we've seen that the price is on a discount as compared to pre-auction levels, and we expect that there could be a gradual reverting back to pre-auction levels or closer to that level. So there could be entry opportunities between 11.3 to 11.4%. Let me stop it there, and Mathew can take it over from here.
All right, just a second, I'll be sharing my screen. All right, ladies and gentlemen, thanks for taking your time to attend this. Let's have a sneak peek of the Forex market. And today I still want to repeat about the risk management. I had last time when we spoke about it, we had the attendees really interested with it, and I decided to just have a repeat of it and show you a little bit of how you can try to do position sizing. So risk management, again, it's the rules that protect you against excessive loss. And of course, as you're entering the market or even when you're trading, you need to understand how you're protecting yourself from a big drawdown. When I say drawdown, I mean when you place a trade and you're losing a very big amount of your capital all at once. So it's very important that you have risk management. Again, it's something you practice. It doesn't come in a day or two. You have to take time and practice. Trade with a stop loss. Make sure that you cap your losses at a specified level where you yourself comfortable with it. If you're in a trade and you don't want to lose more than $20 or $50 or $100, depending on the amount that you have in your equity, that you have as your equity, very important. So remember always to have your stop loss, and as you're stopping the losses, make sure you have a target. Again, invest what you can afford to lose. Don't put your everything there. Make sure that you appreciate the fact that Forex market and any form of trading in securities or financial instruments is risky. So you need, first of all, to set aside how much are you comfortable to invest. Risk tolerance, you need to listen to yourself. Assess yourself, how much are you comfortable to risk? What's your risk appetite? Are you a person that you can allow yourself to see a loss of $20, a loss of $100, a loss of $500 without even having, without blinking? Because we have people like those, and that one is going to direct you towards how much you can risk. But again, it has to be pegged on your amount that you're willing to risk in every trade that you take. Your risk tolerance, you have, there are factors you need to assess. For example, what's your experience? If you have a good experience in the markets, again, it might inform on the level of risk you're taking. If you're a little bit elderly and you are afraid to lose a lot, again, you might want to take a lower risk, those kind of things. If you have a lot of knowledge, you know how you can play around with a bigger contract size, something like that, or even your investment goal. But don't allow these to push you to a bigger risk. Don't allow it to push you to a bigger risk. Let it just be aware of all those aspects and control them. Risk reward, this one is in line with your stop loss. If you're stopping your losses, for example, at $20, that's the maximum you want to allow yourself to lose, or $50 in every trade, then that is your risk. Then how much are you looking to get as a reward? Again, very important. I'm passing through this very fast. Level of risk per trade, we advise that don't allow yourself to risk more than 2% of your account, of your deposit, all right? But again, it's not fixed. It's something you can adjust depending with your risk appetite. Keep a consistent risk. If you're trading and you're making profits with a smaller lot size, and then all of a sudden you want to make bigger profits and you increase your risk, that is not advisable. You need to make sure you have a way you can calculate it to make sure that you don't just keep on increasing based on maybe greed, right? That's how you cap on the effects of greed. Trend, always make sure you can see the trend. Make sure that you understand where the markets are moving. That's going to be very much important to inform your decision or support your decision. Track your overall exposure. Don't take too many trades or one that are affected by one, maybe one of the same aspects, economic aspects, right? That's very important. For example, Australian dollar, there's some correlation with gold, right? And other assets like Canadian dollar, again, some correlation with oil. Okay, so when you're trading with those currencies, also you need to check on the correlations that they have. Something very important, position sizing, and I will do a little bit of maths here just to show you how you can do it. Risk per trade, just trying to compress all those things that we've looked at there. The position sizing, don't risk more than you can afford to lose. The risk per trade as percentage of the capital that you're putting in your account. Stop loss, pips, and pip value per standard lot. And on the next slide, I just want to talk about this. For example, I will be scribbling something here. If you're trading with a given currency and you have an account of $1,000 what you've deposited, how much are you willing to risk in every trade? let's say, for example, don't risk more than 2% of this of your account. So this one means it's 2 out of 100 multiplied by that 1,000, right? And that's going to leave you with $20 to risk in every one trade that you take. So don't allow yourself to risk more than that. If you have 500, again, that's what you do. Now, for you to understand how you position your orders, you take the distance between your entry and exit. For example, if you were expecting an order to be moving up, the price to be moving up that way, and this is where you entered your trade, and then of course you'll be stopping your losses here, right? You need to understand how much is this that you're risking in terms of pips. How many pips, for example? Let's say, for example, this would be 100 pips. And now that you calculated the maximum amount you can risk in a trade, which is $20, now this is going to be equal to $20. So how do you know how you position? So for you to understand that, this is what you do. You're going to take your the amount of money which you're risking, which is $20, you divide it by the amount of pips, the number of pips, right? Multiplied by pip value, one standard lot. If, for example, this is a US pair, a currency with a US pair, which is a major currency, multiplied by 10, because for every one standard lot, the movement is 10. And here you find that you can easily find this is 50, something like 1 out of 50. If you just do this mathematics, you realize it's going to be, someone can do it, going to be 1 out of 50, maybe 0.02, right? Maybe 0.02 or something like that. That one gives you a rough idea of the lot size that you can use, or the position size that you can use, and it will prevent you from making even a bigger risk in the market. Going back again, take profit depending on the risk reward ratio. On the same example here, if you are expecting the price to be moving up, just giving an example, this is where you entered, this is where you're capping your losses, your stop loss, and of course you have here, for example, I said this risk is $20. Then how much are you targeting? That's going to give you a rough idea of the take profit. If you're risking 20 and you're looking up to get $20 in return, this is going to be a 1:1 risk reward ratio, because this is your risk here, this is your risk, and your reward, where you'll be taking the profits, this is going to be your reward, right? So for example, if you're risking this $20 and you're looking up to get something like $40, then this is going to be a 1:2 risk reward ratio. Again, this one is informed by your trading strategy and your analysis, but it's very important that you have a higher reward to the risk, so that at least if for example, you are losing, even if you have a 50-50 winning ratio, then the moment that you win, then you're winning something bigger, again, something to work on. And again, trailing stop, there's something about the stop loss. If, for example, this is your stop loss here and the price is moving in your direction, you might decide that anytime that this price keeps on moving in the direction that you desire, you keep on having this risk, the stop loss moving in that direction. For example, this is your stop loss, this is your entry, and here you have your stop loss. So every time that this market moves up, maybe up to that level, for example, you have the stop loss moving maybe up to that level, so that you're inching on to reducing the risk, so that if the market again moves up by another maybe 15 pips up, then you can have the stop loss again even edging higher, so that now you have the stop loss above your entry level. And even if this price changes and moves downwards and hits that level, it will hit the stop loss, but then it will be closing your order at a profit, something again you might reconsider to perfect on. Moving on to the week ahead, of course, last week recap is that we had COVID-19 vaccine announcement, right? And causing a lot of euphoria in the market. And that one, of course, caused some movements in the big tech stocks. but we have still the virus causing a lot of problems and even cases being higher in the US. European Union, of course, they are preparing for a no-deal Brexit amid fears that time is running out on all those negotiations. Key events this week on Tuesday, of course, we have Bank of England. You see, UK is so much on the spotlight, and pound USD is one of the currencies that we'll be checking on. Again, US, we have the consumer confidence, and Wednesday is a day that you have a lot of news from the US side. Of course, the Federal Open Market Committee meeting that might be maybe a little bit on the stimulus and the direction of the economy. Again, very important on highlighting the strength of the US dollar or the weakness of the US dollar. Those are the news to watch for this week. On the pound USD, you see it's trading above the moving averages, right? And if you see a currency trading above the moving averages, it favors an upward move. You can see it's breaching above that. This is around the pound USD. That one is around 1.3318 levels. If it's testing that level right now, if it breaks above that level, we might see it moving all the way to the highs of 1.3393. But if in case if it just pulls back again, we have support at 1.3149 or 5 there. Again, if it just breaks below that level to the downside, we might see further movement downwards. When you look at the gold, you can see it's hovering along the 1875 levels there, right? And again, trading below the moving averages, we wouldn't fail to recognize the 1850 support level. A very strong support level has been there since September. Again, we're waiting to hear about the stimulus, and if it comes in, of course, might make the gold again soar higher as people try to hedge for the inflation. So currently, that's where we are with those financial instruments. That's my bid for today.
Thank you, Matthew, and thank you, Churchill and Gerald. So we've gotten quite a bit of updates. Gerald, thank you for that recommendation for a long-term buy for EABL. The festive season is coming up, so we need to take part in that particular uptake. And we're also looking forward to seeing the reports for DTB and IMM Bank. So we've gotten questions, so I'm just going to go through them really quickly. Churchill, we'll start with you. The first one's from Evelyn. She says she has a CDS account with Central Bank. So how does she start purchasing treasury bills and bonds? And I was also thinking, Churchill, you could also partly address Eric's question. He directs it to Matthew, but you could also have something to add to the conversation. Eric says the shilling is on track to depreciate against the US dollar for the 5th consecutive month in November. What are the factors behind the current exchange rate, and what's the outlook for the next few weeks? So we could begin with those two questions, please.
Thanks, Damaris. Starting with Evelyn's question, that's also where our client relations comes in terms of the CDS account, because ideally it could either be linked to a stockbroker, which we really wanted to be linked to Genghis Capital, or to any of the banks who are intermediaries between a client and the central bank in terms of the government securities. So as long as you have a CDS account, you can either go through a broker, or you can even get into the mobile direct, whereby you can trade through your mobile. Exactly, you can place trades through your mobile, but linked to the CDS account. So those are the options that you can pursue, Evelyn, as you want to get into the fixed income segment. And the question partly about the shilling, of course, it's been under it's been under depreciation pressure. Not only the shilling, but most of the emerging currencies have been under pressure. Just looking at COVID-19, which has worsened fundamentals for the countries, and hence the exchange rate. For this case, shilling, I think, even in the course of the year, has depreciated close to 7%, if I'm not wrong. And as Eric has put it, fifth consecutive month of depreciation pressure. I still expect it to be the pressure to still be there over the near term, and more so as in light of whatever is happening in the global markets, in particularly COVID-19. Despite the fact that the vaccine has been found, different facets of the global pharmaceutical have been announcing that there's been some discovery or successes of the vaccine to some various degrees. I still see that there's still a huge layer of uncertainty in regards to the global market development, which will now either see, perhaps, in my view, this is my view, could see now the dollar, now people starting to seek safe haven appeal on the dollar, and will now continue seeing weakening pressure on the shilling. Perhaps now, Mathew can do the same.
All right. Just before we jump over to Mathew, though, I just wanted to ask you one more question from your presentation before we move to the next set. Amos wanted to find out what impact does taking the DSSI have on Kenya's credit, our credit score, and the subsequent impact on Eurobonds.
Yeah, thanks, Amos, for the question. And looking at the DSSI, in particularly as the debt service suspension initiative was formulated by G20, they wanted also the private creditors to come on board. Private creditors are now the banks which have given us syndicated bonds, and also the Eurobond bond holders also to come on board. Just to put it in parentheses, Zambian case, the default that happened last week, 13th of November, yeah, that was last week. That was on the Eurobond that was supposed to have been paid out a month earlier, mid of October, and they requested an extension period up until April next year. But now the bondholders did not allow that to happen. So what happened when that 1 month period of discussions came to an end? That was last week. They did not come to a conclusion. So that was considered a default by Zambia. So anyway, that's end of my parenthesis. But the point I'm trying to bring on board is now, even with this, the SSI, they wanted to bring on board even the private sector creditors on hold. Looking at even the public debt, external public debt, you find that our the split of external debt is a third to the Eurobonds, a third to multilaterals, that's the IMF, World Banks, and the other third is now for the official bilateral creditors. That's the breakdown of that, so it's a third each. So, but right now the DSSI does not bring on board the private sector's creditors, so it's mainly the official creditors. So in this context, and that's something that it's them who have said that they want to extend the debt relief to Kenya. So I don't think that it will have any impact on the ratings. I know that Kenya is now under negative rating by Moody's, by Fitch also, and also S&P, all these global rating agencies, but I don't think it will have an impact now that private sector creditors are not asked or are not being forced to be part of this DSSI.
Thank you so much for that comprehensive answer, Churchill. And Amos, I trust you've gotten the necessary response. Mathew, over to you. Perhaps you could also tackle Eric Ombok's question about the shilling depreciating. And then Ian Wangai wants to find out if FXPesa has daily briefings to give fundamentals on the currencies you touched on. And I see here a question from Mark. So Mark is asking, although Mark, I think we have the answer. Mark is asking, the same way one can give permission to Genghis for them to trade on their behalf, can one also do the same with FXPesa? And I know, Matthew, you fielded this question last week, but maybe you could respond to it again this week.
All right, good question. About the Kenyan shillings, for me, I think it's because, of course, we have a lot of uncertainty globally, and people are preferring holding dollars and other hard currencies. So on that point, you see that the demand for foreign currencies, those hard and strong currencies, of course, is going to weaken the shilling. And there's a slowdown in foreign dollar currency inflows, of course, little traveling, and that's what used to bring in demand for the Kenyan shilling. But right now, those things are in slowdown and could be part of what is really affecting the Kenyan shilling. Of course, there are other aspects, things like slowed exports. Of course, there are things that we export, and that again helps strengthen the Kenyan shilling. But most importantly, it is the slowdown of the inflows of the stronger currencies, and even as people want to hold those strong currencies. When it comes to the fundamentals on the analysis, of course, we have first of all, we have the not Instagram, it's called the Telegram channel, that gram thing. The Telegram channel that we always give trading analysis and any other information that we have. But again, on a daily basis, we send the market report and some analysis just to inform or give our clients on the things that might be happening and give direction or on the currencies and other financial instruments. On trading for clients, again, we don't do that. We come in to support you to understand how you can trade for yourself. And that's because we are an undealing broker. We're not allowed to do that. But maybe with time, we might be getting the multi-asset, multi-account management, the MAM and PAM accounts in the future. But again, I'm not here to preempt anything. We have to wait for the management to see how they're going to take it. But currently, we're not trading for the clients. I will make sure that I pass on this to our management and see if it's the direction that they can take.
Perfect. Thanks, Matthew. And I think you've also addressed Ezekiel Wanja's question, because he was asking similar about having you trade on their behalf. So yes, we look forward to getting feedback in the future. Gerald, let's bring you into the conversation. We have Crispin who's asking, the Centum stock has seen a downside of at least 20% since your buy recommendation about 6 weeks ago. What, in your opinion, is this attributable to, and what is the current outlook on this counter? Secondly, I have a question from Patrick Mutama, who says, what's your view on the banking stocks, especially Equity and KCB in the medium term? And then Ian is asking, is there any chance of KPLC price turning back to a high with the current news of the company's move to solar as a source of power? I really like that question. So Gerald, those three, please.
Thank you, Damaris, and thank you for the good questions. So yes, for Centum, the prices has come off quite substantially. I think currently it's trading at a price to book of about 0.2, basically 20% discount to the net assets of the business. And when you look at the compositioning of its assets, the diversification of its assets in terms of PE, in terms of real estate, in terms of projects, I think it's quite good. Although when you look at the book value of the business right now, it's quite heavy on real estate. And I think that is one of the key risks that we have previously flagged, because on the current environment, definitely real estate is having quite an impact. And even from the banks that have given some details in terms of performance of their loan assets, you can see some pressure on the real estate side. So I think that is definitely have an effect on the price of Centum. However, I think the positive news from them recently is that they are collecting in terms of exiting some of these projects that they have completed from the Pingo and the like. But the overall picture of the business is that this is definitely going to be some impact from the current environment that we are having, where cash flows is definitely a big challenge for most of the businesses. In terms of the banking sector outlook, yes, negative what we have seen so far this as at third quarter. I think there's not going to be any improvement going into the fourth quarter. Provisions are still expected to be elevated even for a major part of next year, because remember we still have those loans that were restructured, which were quite substantial, and if those loans are still going to be having challenges post 2020, then we still expect provisions to be elevated for most of next year. However, there's still uncertainty about recovery of most of the businesses and how the pandemic is going to be. But if there's positive news and business are able to return to profitability and to business activity, then we could see some improvement from there. Yes, KPLC, there's been news recently. Well, it's quite concerning for KPLC basically, but I think the business is large enough to withstand most of what most of the customers that are moving from the grid to the solar side. I think most of these most of the big customers will be there, because figure out a plant like Bamburi that is doing cement. I don't think the operations of Bamburi would be sustained by a solar panel or solar panel power. So they still have that, but the business outlook, from the other customers, mostly domestic and small businesses, those have a little bit of flexibility in terms of adopting alternative energy, and especially solar. So for them, I think the key is to really look at the business and look at where the costs are being a challenge, because I think the revenue side has been okay. They recently increased their tariff. This led to revenue growth of about 20%, but I think the cost side has been growing much faster than the growth in the cost. That's why you're seeing the business basically reporting decline in profitability. So I think if they address the cost side of the business, looking at system losses, looking at operational losses, looking at also all the processes, procurement, and all these scandals that have been there, I think they can be able to handle the cost side, and the business could be a little bit stable. Back to Damaris. I hope that answers those questions.
It has. Thanks so much. Just maybe in a sentence or two, Gerald, you could answer Lucas. He says, would you recommend accumulating Centum stocks for long-term investment? I know you already touched on it, but just a quick emphasis.
Yes, for long-term investment horizon, I would recommend it because of the discounted, price to book ratio. It's discounted about 20% of net assets. I think it's a good entry price.
Okay, perfect. All right. There's been a number of questions about the Telegram group, Mathew. So what I've advised a lot of our participants is just to search the word FXPesa on Telegram, because at the top there is like a search. Just type in FXPesa, then our channel will appear. The full name is FXPesa, Create the Opportunity. So if you search that, you'll be able to find the group and join. And while you're at it, you can also do the same for Genghis Capital. We also have a Telegram group. Just search Genghis Capital and it'll be listed as one of the channels available. Churchill, a couple of questions for you. So the first one is Kevin Kakuti, who asks, what does dirty price mean? I think, Churchill, we need to do those videos we've been talking about, like a disambiguation of all these terms we use. But maybe you could explain to Kevin quickly the difference between dirty and clean price. Joseph also asks, Joseph Areo, how liquid is a secondary fixed income market, especially for he's thinking more about sovereign bonds. So Joseph wants to know how liquid the market is. And then Justice is very interested in this conversation you started about debts. First, he asks, are we clear on the conditions for qualification for this debt suspension? And secondly, taking it even further, do we know the conditions under which bi- and multilateral agencies lend us loans? So Churchill, in your bracket.
Thanks, Damaris, for those sets of questions. Let me start with Kevin's question about dirty price. Think about it this way. Perhaps just to bring everyone on board, for every bond that are issued by the government of Kenya, they pay coupons twice a year. So you find that in between, there could be some reopenings or there could be some trading activities that happens. So the price of the bond, basically, there's a time I did that math, and now Damaris, I think we need to put a different session where you could do that whole explain again. But the price of a bond basically is just two things. Once you know the yields and you know that the future cash flows of the bonds, this is now the semi-annual coupon payments, and also the principal at the end of the year or the lives that are still remaining on the bond, you just work it backwards, you just discount backwards. So that gives you the clean price of the bond. For instance, say a 5-year bond, which has a 10% coupon rate. So for after every 6 months, it will be giving us 5 on every 100 of that for 5 years, and then at the end, it will return to us the initial investment that invested in. So that's 100. And then the price at a given point is just to discount those payments up to with the yield that is given at that point. But the accrued interest basically is now, say you are on the third year or on the third month in between semi-annual payments. So already you have accumulated half of the coupons that you're entitled to for the next coupon payment. I don't know whether it's clear. Coupons paid in 6 months, every 6 months, and in between, of course, there's that from the last coupon payment up until that particular point, there's that coupon payment portion has been accrued. So it's future payment, but already in a bond, you also have to pay that portion of the coupon that has been accrued to the seller of the bond. So that's where the dirty price comes in. So essentially, the dirty price is now incorporating the coupon from the last coupon payment. So that I hope I have simplified it to Kevin and to anyone who was a bit lost about the dirty price. FXD is now the fixed rate bonds. How the government of Kenya categorizes bonds is either a fixed rate bond or an IFB, an infrastructure bond. But the name FXD, because even infrastructure bonds gives out fixed rate bonds, they give out coupons at a fixed rate. Just the differentiation comes in between IFBs, infrastructure bonds, and all the FXD bonds. Moving on to must be Joseph's question about liquidity. Let me put it this way. Looking at let me paraphrase the question this way. There's a mismatch at the secondary market at the moment, whereby most of the domestic debt holders are banks, around 55%. And with banks, because of their asset liability matching, they are more prone to look at the short-term papers, basically say anything 5 years and below, that's where their interest is. But the government treasury has been issuing longer term longer term papers from in the current financial year, from July up until the November issuance, there have been either a reopening of some longer term papers, but the skew has been towards the longer term papers. So you find that there's a demand for short term papers, but there's no unequal supply of the short term papers by the in the primary issuance market. So there's a disconnect at the secondary market. So what now happens is, either as an investor, you look at longer term paper, but at the back of your mind, you have a shorter term investment horizon. For instance, your interest could be for a 5-year paper or a 2-year paper, but because there's no supply for the 2-year paper, you might be forced to look at a longer term paper, say 10, 15-year paper, but with an investment horizon at 2 years, meaning that you'll exit at the end of the 2 years. So that is what happens at the secondary market, just the demand supply developments. On the other hand, if I may answer your question about the liquidity, if we look at the last 2 weeks, what CBK's action has been, they've been coming into more excess liquidity. Back again, banks are the major domestic debt holders. And right now, they are not aggressively lending out loans. So that means that as they accumulate the deposits from people who come, and right now there's been an influx of deposits by banks, either discretionary savings. So they've been sitting on it rather than lending it out on the same. So what happens is now banks are having excess liquidity. Of course, in between, there's some one-off liquidity factors, such as when government is spending, or when, like last month, there was that T-bonus, which of course was an added liquidity point for the banks. So the point I was trying to bring is that the last 2 weeks, we've been seeing more mop-ups of that excess liquidity, which is an indicator that liquidity level is quite high in the banking sector, which is a major player, and it could be supportive of uptake of domestic bond issuance. So that is what is playing out at the moment. Right now, as we approach the end of the year, there's usually deposit mobilization by banks. So you could see even that liquidity by banks starting to thin out as we head towards the end of the year. But that said, the bias has been towards liquidity in the market. To the question about justice, yes, about debt suspension. What are the conditions? One is you have to be classified as an IDA country by the World Bank. So that comprises of around 76 countries, inclusive of Angola, which is also part of the IDA. So that is the main scope of beneficiaries for this debt service suspension initiative. So far, I think there's been around 43 thereabout countries which have already requested for the debt relief from G20 and the Paris Club, both of them. Let me just go back to the question that had been asked about effect on Eurobonds, and I would like also to mention that Angola and Ivory Coast, notably, they also have Eurobond that they have issued, and at the same time they have had debt relief from the G20 group of countries, and it has not even had a massive impact on the Eurobonds. This is something that let me just bring it, though it partially tackled it in my earlier response. So conditions under which bilateral and multilateral give us loans. Of course, for bilateral, most of the bilateral loans are either towards the development projects. Basically, those government-to-government loans, those goes to development projects. Of course, we have with China, the lenders are now China Exim Bank, majorly, and China Development Bank, the other player. And most of the loans that are being issued by China, they don't do government to government as much as the other official bilateral creditor nations, but their China Exim Bank loans are deemed to be in concessional terms, as opposed in commercial terms. So concessional terms is more or less like what the other official bilateral creditors give us. But we haven't seen much visibility in particularly some of the loans that have been issued to Kenya. The one that stands out, of course, is the SGR project. The terms of the financing of those loans could be able to dictate whether it was issued on a concessional basis or on a commercial basis. That said, I know that last week but one, there was a report by the Transport Committee, which one of the recommendations as they were looking at the SGR was at least to have Kenya renegotiate the financing terms of the SGR project, at least to reduce the pressure of that. On multilateral agencies, that's the IMF and World Bank, basically these are on concessional terms. But what comes, with the multilateral loans, particularly World Bank and IMF, there are some conditions that are tied. What I mentioned, even with the IMF budget support that is still being hammered out, there are talks that it's being pegged on fiscal consolidation, so things to do with raising the revenue. So trust you me, once that program is in place, we could see even some increase in some taxes, or at least to reduce the deficit, the fiscal deficit from 8.9% in the current financial year. Let me stop it there. Damaris, back to you.
Thank you so much, Churchill. Your comprehensive answers are really appreciated. We had a couple of questions in the chat which I've attempted to assist. Mani, I will share your details with our client relations team and they'll be able to advise you on your account activation. There are a couple of people who've been sharing their phone numbers, but I've asked for advice on the particular product you need assistance with. So hopefully we'll be able to get responses from you. Earlier, about brokerage charges for trading with Genghis for shares. So I responded to you on Q&A. I hope you saw the response. And I believe that brings us to the end of our penultimate edition. We are going to share the recording for this session by Wednesday. I hope you received the links last week. If you attended last week's session, we shared the links to the FXPesa training course, to the, the platform that would allow you to open up an account with FXPesa, either a live account or a demo account. So I can include that in this week's email as well, just in case there are a couple of new visitors to our webinar. Just one final question popping in. Martin, you want information on CDS account. So Martin, I've noted down your name. I'm going to email you using the email address you used to register for the session. I'll send you information regarding CDS accounts and how you can open one. Thank you, Mathew, Gerald, Churchill. I look forward to having you here again next week for our final edition for 2020. So everyone else, have a great investing week. In case you have any other questions, you can reach out to us on info@genghis-capital.com or any of our social media pages or our Telegram channels. We are very responsive. So have a great day and thank you for attending.